Now, most people believe that taking their tax-free cash is a simple and straightforward process, but one wrong move could mean that you lose out on thousands of pounds. Now, there are many simple mistakes around taking your tax-free cash, and once that decision has been made, there is literally no going back. So what should be a fantastic opportunity has just been wasted, but worse still, most people only realise their mistake once it's too late. So every year, those who are eligible to take their tax-free cash do it in the wrong way. And that means they could be losing out on investment growth and run the real risk of running out of money in their retirement and facing years of financial regret. So in this week's video, I'm going to cover the different ways you can access your tax-free cash in a way that it can work for you instead of working against you. Hi, my name is Simon and I'm a chartered financial planner with decades of experience of helping hundreds of clients and their families plan ahead for their retirement. So welcome back to the channel, and if this is your first time, a very warm welcome. Now, we all know that money matters, so together we're going to make money make sense. So turning 55 and being able to access your pension fund and taking your 25% tax-free cash for the first time comes with a whole range of emotions, and not all of these come with your best interests at heart. It's almost like Pavlov's dogs salivating at the prospect and the possibility of clearing your debts, paying off your mortgage, replacing your car, booking yourself a luxury holiday, or even helping the children. Now, there are several ways to access your tax-free cash, which could either make or even break your financial future. Now, get it wrong, and you could face unnecessary tax bills. You run the risk of running out of money too soon, and it can even reduce the amount that you can leave to your family. Now, a recent interactive investor report revealed that between April 2023 and August 2024, that 53% of people withdrew the maximum 25% tax-free cash lump sum in full. 39% of those people put their tax-free cash into a bank account. About a quarter of the people used their money to repay debts or even their mortgage, and 12% of people used it for everyday living. Now, what this tells me is that the majority of the 9,000 people surveyed had a knee-jerk reaction to taking the tax-free cash in full without even needing to take it. They just wanted to get their hands on it. And of those people who did take the tax-free cash in a lump sum, about 40%, that's 4 in 10 people, took the tax-free cash, which was growing tax-free within the pension, and put it into a bank account which attracts interest, which you then have to declare to HMRC and then pay income tax on it. So before you rush in to withdraw the tax-free cash, let's explore some of the current rules, how you can also access the tax-free cash, and we're also going to look at some of the advantages, the disadvantages, and the risks of taking the tax-free cash so you can avoid making some of the biggest mistakes that people make, leading to years of regret. I'm also going to leave a summary table at the end of this video with all these options for you, so you can have a look at the pros and the cons of each of these and then refer back to them later. Now, of course, there are going to be exceptions, but for most pension schemes, they will allow you to take 25% of your pension fund as a tax-free lump sum up to a maximum of £268,275. And that's going to be from age 55, but that's rising to age 57 in April 2028. So you might be asking, why are these goalposts always seem to be changing? Well, in short, it's because they believe that you can't be trusted with your own money. So you're only going to be able to access your pension 10 years behind the state pension age. So as a state pension rises to age 68, for example, and beyond, you're only going to be able to access your pension 10 years behind that. Now, of course, you can take the tax-free cash in one lump sum, but then the rest of your fund then becomes taxable. You can also take the tax-free cash in smaller bite-sized chunks, for example, 5% each year for 5 years. You can also phase the tax-free cash monthly to top up your income without paying additional income tax. And you can also take the very snappily titled and very easy to understand UFPLS, which stands for the Uncrystallised Funds Pension Lump Sum, or as we call it, UFPLS. And that's a payment where it's split between 25% tax-free cash and the rest of them is going to be taxable income. Now, you also may come across something called small pots, and these are basically pension funds with less than £10,000 in them, and they can be encashed as well, and these could be perhaps small workplace pensions, for example. Now, they are also split 25% tax-free and 75% taxable, similar to the UFPLS we talked about earlier. The only difference here is that they do not trigger the money purchase annual allowance, which limits your future pension contributions to £10,000 a year without penalty. So if you're finding value in this video so far about how to avoid the tax-free cash mistakes that most people make, then please hit the like button and then subscribe to the channel. We're going to be growing this financial planning community throughout 2025, and you are more than welcome to come along for the ride. And you might also want to hit the notification bell so you don't miss any of this weekly and valuable content. So let's go through some of the main 5 mistakes together. So number 1, taking the maximum 25% tax-free cash when it is not needed. Now, this is going to result in lower investment growth as a chunk of your pension is now not being invested. So there's going to be less long-term compounding, which could give you a larger pot of money in the future to draw from. Now, this can also lead to all sorts of temptation, as well as a knee-jerk reaction to need to spend the money on stuff which you just don't need. Now, it's amazing how money just seems to vanish over time, doesn't it? And no one's ever got any idea about how it happened. Now, don't forget, once a 25% tax-free lump sum is gone, it is gone forever. Mistake number 2, ignoring the tax-efficient withdrawals. Now, most people ignore the fact that you can take partial, smaller but regular tax-free lump sums over time, for example, monthly. Now, this allows the remainder of your fund to continue to be invested and to continue to grow in a tax-advantaged pension. Now, you should also need to consider phased drawdown if it's available to you via your provider. This is going to allow you to take a monthly payment, which is a mix of tax-free cash and taxable income. So let me give you a worked example. If you had no income from any other sources, you could take the taxable income up to the personal allowance of £12,570. You then had the 25% tax-free cash added of £4,190. That means you'd have an income of £16,760 and pay no income tax and no national insurance either. And that works out to be £1,396 a month in your pocket with 0 deductions. Now, if you do decide to take this approach, it means you can control your withdrawals as well as your income tax as well. So mistake number 3, not using your UFPLS. Now, this is similar to phased drawdown, but the main difference is that you don't need to crystallize your pension and then move it into a drawdown facility. And this is very useful if you only need to take small amounts at a time, which means you can manage your pension without making larger or lump sum withdrawals. Now, this will trigger the money purchase annual allowance, which means that you're only going to be able to contribute £10,000 gross per tax year into your pension, and this could severely limit your ability to fund your retirement, especially if you've got a very generous workplace pension scheme. So mistake number 4, not paying attention to the recent changes which brings pensions into the IHT regime. Now, pensions have always been exempt from inheritance tax due to pension freedoms which came into force in 2015, and these have become a very popular way to pass on wealth to the next generation. Now, all that changed in October 2024 in the budget, and pensions will now be assessed for inheritance tax from April 2027, unless there are any major changes. So make sure you keep watching the channel, because if there are any changes, you'll be the first to know about it. So let's say you're married and you've got a combined estate in excess of £1 million, and that's going to include property, your savings and your investments, your pensions, either personal or workplace pensions, and any life insurance that you've got which is not placed in trust. All this could then mean that your pension could be taxed at 40%, and then any income withdrawals by your children will also have income tax deducted as well. That could mean that a total of 67% is going to be lost of your pension to the HMRC. So if you are considering withdrawing money from your pension to give to your children whilst you're alive, make sure you've got a firm understanding about the gifting and the 7-year rule. And number 5 is not having a plan in the first place. Now, jumping in to take your tax-free cash should never be an impulsive decision. Now, I know of many people who decided to take their tax-free cash in advance of the budget, and now they are completely stuck as they can't just reverse that decision and just put it back into their pension. So you need to ask yourself these following questions. Do you need the money right now? Will the tax-free cash have an immediate and a positive impact on your retirement plan? And how is this going to impact your spouse as well as your family? Now, if you don't have honest answers to these questions, do not rush into anything, and it might be better just sitting on your hands and then leaving into the pension until it's really needed. Now remember, your pension needs to work for you and not against you. Now here's the table on screen that I promised you at the beginning of the video, which is going to highlight the formats to take the tax-free cash as well as some of the pros and the cons. And feel free to then just pause the video and then take some notes. So I've linked a further 2 videos in this series. One of them is a video about tax-free cash, which I recorded about 9 months ago before the changes in the budget. And there's another video, which is a deep dive into the 67% pension death tax, which is coming into force in 2027. So thank you so much for watching to the very, very end, as well as for your time and for your patience as always. I'm going to see you all again next week.